Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. On today's episode, we'll take a look at the potential effects of President-elect Trump's cabinet picks. In a moment, we'll be joined by Mark Matthews of Julius Baer in Singapore. But first, a look at China's interest rate landscape in front of next week's meeting of the PBOC. Joining me now is Wang, head of Greater China FX and rate strategy at BNP Paribas. She joins from Hong Kong. Ju, thanks for taking the time to chat with us. So many things to talk about in the wake of Donald Trump's presidential election victory here in the U.S. One of the unmistakable reactions has been this backup in U.S. Treasury yields, and that in turn has led to a rally in the U.S. dollar. I'm curious as to whether or not you view these moves as being durable, or are they kind of temporary phenomenon?
I think the move has been in line with our expectation on the Republican victory. So market conventional wisdom is that under Trump's administration, the policy is going to be more inflationary, given what they prefer to do, for example, on the immigration policy, on the tariff front. These are all quite shifted towards even more inflationary kind of a bias. So as a result of that, the U.S. yields have backed up and the dollar has strengthened. So far, these things are moving very, very consistent with this conventional thinking about a future U.S. Policy bias.
Yeah, but if you look at the way in which some of these Asian currencies have been behaving, the Japanese yen, weak, offshore Chinese yuan, weak as well. I know we have a PBOC meeting in the week ahead. When you look at that type of yuan weakness, does it present a challenge for policymakers at the PBOC?
Actually, the dollar-RMB move is exactly in line with our view. We are thinking that at the initial reaction of Trump's victory, dollar-RMB is going to bounce back towards the 720, 730 range, but not beyond. And this is just to keep the RMB to be consistent with the broad dollar move. And the euro move, to be honest, is also quite consistent. Our house view is that potential 10% tariff can trigger 4% drop of the euro dollar. If the Fed is going to revert back into a tightening trend, maybe 7% drop of a euro. And so far, we have had a 5% drop of the euro since late September when the market first positioned for this U.S. election to the current level. So I think the initial first round of reaction towards the Trump victory and tariff threat is already here. The next question is, will inflation resurge in the U.S. and hence the Fed will be forced into tightening trajectory? And if that's the case, maybe we have another round of dropping euro. But I think at the moment, we're thinking that the market reaction has pricing fair amount of initial reaction towards the Trump victory.
So do you believe the House view at BNP Paribas that these tariffs will in fact go into effect, that it's not just a kind of a bargaining strategy, a negotiating ploy on the part of the incoming administration?
Looking at the track record of President Trump in his first term, he did manage to deliver quite some of the tariff threat he had promised. So we do think the market is thinking that we will get some tariffs into 2025 and incoming and later. But markets also question whether 60% tariff is possible. Given that is a tremendously higher level of tariffs compared to his first term, and whether the world can handle 10% tariff for all countries and 60% on China. So in that sense, I think the market is thinking some tariffs will come, but again, that will serve as negotiation tool by the Trump administration for for more benefit for the United States.
Let's talk a little bit about what's happening in China. Last week, we had the meeting of the National People's Congress. A lot of the focus was on supporting local governments to do more, especially where the property market is concerned. Very little attention seemed to be paid to boosting domestic demand. Is that a concern in the macro?
Our overall view is that China policy has started to shift towards more pro-growth and pro-domestic demand territory. So the fact they announced the $6 trillion of debt swap for the local government debt and some other additional resources, the total package is nearly 12 trillion RMB over the next 2 to 3 years. That's definitely mark a turning in policy stance. We are all aware that starting from early 2021, China was in a deleveraging kind of trend triggered by the property sector restructuring, and this has come to the end. But we're also emphasizing that even 12 trillion over 2 to 3 years, that's not yet a bazooka level. Just to think about the potential tariffs that can have a damage on the China's exports into 2025. The various houses have different estimation of our potential damage on GDPs. I see numbers range from 1 to 2% for GDP, and China does need to do more on the domestic policy side to support the growth. So we're thinking that this 12 trillion over 2 to 3 years, on average, every year you get, maybe 3 trillion stimulus. That's just to offset the shock from the external side. So netting net, we see things are turning, the policy stance are turning more supportive. You can see that in the local stocks, particularly the local focus, CSI 1000 type of index rather than the foreigner-focused ones, because foreigner-focused ones are more impacted by the dollar rates and the dollar views. There's a sign of relief. Local people start to opening stock accounts and participating more in the stock market. So in that sense, they also believe that policy has turning more pro-growth. This is not bazooka level.
It's interesting that you kind of put your finger on the equity market as a leading measure of sentiment. Would you do that over, let's say, the property market? Is that the more reliable indicator of kind of retail or consumer level sentiment?
On the property market, we did see a property transaction volume picked up in Tier 1 cities in October. But we're also emphasizing there's always a lead and lag effect regarding financial market versus actual economic activities. So in terms of financial markets, actually, if we look at the property developers, dollar bonds, they have already started to recover at the beginning of this year. So they were one of the best performing credit products in the world. So the equity market only started to react in late September. So the actual economic activity, which we're referring to property investment, we don't think that can bottom out so quickly. It still takes a time for market to reduce inventories. The new home sales needs to pick up in a sustainable way for a couple of years. Then we reach a point that inventories are going to be low enough for the developers to buy lands and start investments. And by that time, we will see sustained improvement in domestic demand. And between now and then, we still need the policies to plug in. Essentially, that's what they have started to doing, issuing more central government bonds, issuing more special local government bonds to swapping the existing hidden local government debt and lower the mortgage rates for the household, et cetera, et cetera. So we think overall we are in the gradual bottoming process. The market has run ahead of itself in September and hence got pulled back, especially when they come to realize there's a threat of tariffs into 2025. But we're thinking that purely look at the domestic focused, products like the CSI 1000. These are good indicator of local people start to believe that liquidities and policies are turning more pro-growth.
So maybe China is able to meet that 5% growth target. What do you think?
We think they'll probably be able to get close to that for this year end. Next year, the challenge is really high given the tariff threat I mentioned earlier. So theoretically, they need to do more. But as I mentioned, that additional at least 2 to 3 trillion of fiscal spending into 2025 is there to offset the exports shock. needless to say, the growth is still going to face a lot of headwinds given the global uncertainties.
No doubt about that. Chu Wang, thank you so much for joining us on the Daybreak Asia podcast. Chu Wang is head of Greater China FX and rate strategy at BNP Paribas, joining us from Hong Kong. Mark Matthews joins us. He's managing director, also head of Asia research at the bank Julius Baer, joining from Singapore. Mark, thanks for making time for us. Can we begin with the results of the U.S. election and what the impact of President-elect Trump, we've heard now about several cabinet appointments that he intends to make, what that has done to your thinking on putting money to work in markets?
Well, right now it hasn't changed my thinking, Doug, because if you look back at his first term, Trump often differed from his top advisors. And as we all know, he has a history of being unpredictable. As a matter of fact, I think he does it on purpose. He surrounds himself by very hawkish advisors, and then he does a kind of good cop, bad cop routine with himself being the good cop. And so, I know a lot of people are concerned. Mike Waltz, Marco Rubio, Elise Stefanik, John Ratcliffe, and Robert Lighthizer will undoubtedly be back as trade representative. I'm sure Peter Navarro will have a role somewhere. They're all hawks on foreign policy, especially on China. But I think that he's going to do the good cop, bad cop thing. And I think he's going to side more with advisors who are from the private sector, particularly Elon Musk, when it comes to China in particular. And those kind of people, the private sector advisors, they don't want a Cold War. They actually want improved relations with China. So very hard to say. But, if I had to guess, I think that the relations will actually improve.
Well, there's a lot to unpack there. I want to talk about the China angle momentarily, but you mentioned Elon Musk, and tonight the president-elect announced that Mr. Musk will be working in conjunction with Vivek Ramaswamy to lead the U.S. Department of Government Efficiency. They're calling it DOGE. Little ironic, perhaps. When you look at the way in which the bond market has been reacting to a lot of what it expects to see in terms of Trump policies, particularly on the subject of tax cuts. We've got yields elevated right across the curve, as you know. Could this be one of the guardrails that kind of contains the ambitions of a new administration?
Well, I think absolutely, Doug. I think you're right to say that because there was a broad assumption leading up to the election that Trump equals inflation. And I'm not saying inflation's going back to 2%, but I don't think it's going to spike because of all the pro-growth policies of the Trump administration, including tax cuts. And one of the reasons is just what you said. There's so much fat that could be cut from the government that those two individuals will be, looking for. That government spending could, not rise as quickly as it had been anticipated, and that in turn would put a handle on inflation.
So we were talking a moment ago about the U.S.-China relations, and we know that President-elect Trump is insisting on imposing some type of tariff, maybe as much as 60% on Chinese goods that would be imported to the United States. Are you expecting a full-blown trade war here, or is this just a bargaining chip and we're going to see some negotiation between Washington and Beijing?
I think it's a bargaining chip. And by the way, China responded with one of its own overnight. Apple's facing a lawsuit in China over its App Store practices. So you're going to have that tit for tat. But what I would say is, broadly speaking, not just the United States, but everyone in the world is getting a little antsy about China's exports because they just keep going up and up and up. So I think the political ties are going to improve based on what I just told you. But the general plan of action, I think, when it comes to the commercial side, will be to try to reduce the U.S. reliance on Chinese exports by making more things at home and also buying from other countries. Now, I would say one caveat is if China builds factories in the U.S., and that sounds very improbable because people are worried that, there's electronics and electric vehicles, so they could be spying on the drivers, and Chinese car companies rely on their own supply chain. But somehow, if they could circumvent those issues and make cars in the U.S., I think that would be a huge game changer because if you think back to the 1980s when relations with Japan were very frosty. And then Japanese companies built cars in the US, and that really helped to improve the relationship between Japan and the US. So imagine if China was actually seen as adding jobs to the US economy instead of just taking them away. What a sea change in perception that could be.
When you look at what's happening in China right now in terms of the economic weakness and the very impactful and strong deflationary pressure that's been building for quite some time, is the stimulus that has been announced recently by Beijing, do you think that's enough to improve the situation in a meaningful way?
I think if you add it all up, yes, but we don't have all of it. And I think what at least the experts are saying is we probably won't have all of it until March at the two sessions meetings next year. In my mind, the most important thing is that there has clearly been a policy pivot. They want to stimulate their economy. And being a command economy, if they want to do it, they will. They have the means. So I think it's very meaningful, and there's more coming.
I almost hesitate to draw the analogy between what's going on in China these days and what happened to Japan 30 years ago. Maybe it's a well-worn analog, but is it relevant? Is there the threat, perhaps, that China could get mired into a deflationary trap for some time?
Yeah, balance sheet recession. I think much depends on property prices because 80% of Chinese household wealth is in residential property. Ergo, if prices keep going down, consumer confidence is not going to recover. I am personally hopeful that this stimulus and the stimulus that I anticipate will be coming in the beginning of next year will be enough to stop residential property prices going down. I mean, broadly, I would say around 3 months from now, I would expect a bottom in prices and not a sharp recovery. But if there is a bottom in property prices, then you're going to see a consumer rebound. And so I'm optimistic looking into 2025 for the Chinese. I think they, as I said, they've made a very big 180-degree turn.
It's going to be very interesting. As you know, later this week, we're going to get the monthly activity data, industrial production, retail sales, two key data points. I'm curious, Mark, as to whether you're putting money to work in Chinese equities right now.
As a trade, yes, but structurally, we're not committing any money to the Chinese market in terms of the core portfolio. And there are many, many reasons for that. But I think the biggest reason is that the state's involvement in the private sector has radically reduced the return on equity of the big technology stocks that drove the bull market in the previous 10 years. And I don't see that itself changing meaningfully. The fact that this government prioritizes the public sector over the private sector, that reduces the return on equity of China Inc. So tactically, yes, I think it's going to keep going up because of the reasons I just said, and also because it's an extremely cheap market. I mean, I can find several dozen companies where numerically the price-earnings ratio is below the dividend yield. And I remember Peter Lynch used to say back in the 80s that if you can ever find a company like that, it's certainly worthy of investigation because it shouldn't happen.
Yeah, you're right.
So China's got tons of them. It's cheap. It's a command economy where they're clearly saying they want the economy to start growing again. It just adds up to me that the stock market should continue to rise.
Are you seeing opportunity elsewhere in Asia across the Pacific Rim?
Yes, there is. I mean, there is certainly opportunity in this part of the world. Japan, on the whole, is a low ROE market because there's too many middlemen, and the keiretsu nature of many of the big companies means they've got their fingers in too many pies. They're too scattered. However, it's such a large market, you can easily construct a basket of companies with returns on equity in the 20s and above. There's actually about a dozen of those kind of companies too that are large and liquid. So, I mean, there's good companies which have global brand names, by the way, which the rest of Asia lacks, and high ROEs in Japan. And then Southeast Asia, you can go from Thailand, where Thaksin's daughter is prime minister, And therefore, it's a pro-growth government. In Malaysia, the new Agong, which is their king, is the Sultan of Johor. He's pro-business, and Prabowo is pro-business. In Indonesia, Marcos is pro-business, and Philippines. So I think we have pro-business governments and economies that are doing well in Southeast Asia. So yeah, there's plenty of pickings in Asia outside of China.
Mark, we'll leave it there. Pleasure to talk to, as always. Mark Matthews is Managing Director. He is also Head of Asia Research at the bank. Julius Baer joining us from Singapore here on the Daybreak Asia podcast. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.